The new generation of fintech companies have a tremendous growth potential as they benefit from the digitization of almost everything financial. I'm going to go through the top 3 fintech stocks today and explain why these companies have decades of runway ahead. I think these are really disrupting traditional banking and then also opening up new opportunities for new businesses and cheaper, faster, more efficient payment methods. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start the discussion with SoFi. SoFi is technically a bank, but this is really much more than a banking company. Yes, SoFi got its start offering student loans and personal loans. I look at that as a Trojan horse to get into the banking business. Those are areas of banking that traditional banks don't really want to take part in. They don't want to put a large number of those kind of loans on their balance sheet, so they traditionally stay away from them. But that was really SoFi's way into the market. But it's not a majority of their business today, and the strategy is changing in the lending business. If you just look at their lending revenue and contribution profit from lending, you can see that the business has slowed down a little bit over the past couple of years. Now it's picked up in the most recent quarter, but the strategy for SoFi to grow in lending in the future is not going to be taking more loans onto the balance sheet, which would be what a typical bank is doing. The strategy is to facilitate those loans and then sell those loans to third-party investors. That's what you see in this agreement with Fortress Investment Group. They're going to invest $2 billion in the loan platform, agreeing to buy personal loans with funds managed by Affiliate Investment Group. And SoFi is just originating loans on behalf of third parties. Now, the key, as Anthony Noto says here, is this diversifies SoFi towards a less capital intensive and more fee-based source of revenue. That fee-based source of revenue allows SoFi's business to be much more scalable. They're going to be able to grow their loans at a faster pace than they can grow their balance sheet. That's really the challenge with the banking business in general, is you can only grow as fast as your balance sheet grows. But this isn't the only growth avenue for SoFi. They also have a technology business, and that's driven by what's known as Galileo. What they're doing is white labeling banking solutions for other organizations. Sometimes that's for banks, sometimes it's for companies that are trying to offer some sort of banking solution. So H&R Block, you can deposit money and get a yield on that return. That's not actually an H&R Block product. That is a SoFi product driven by Galileo. And this is, again, another one of these scalable businesses that SoFi has. So they're offering things like credit cards and debit cards, services that certain companies don't necessarily want to do themselves. They don't want to become banks, but they want to offer banking type solutions. So again, this is a fee-based business. And SoFi can grow this business, scale it very profitably as more of these services are demanded by their customers. The third growth driver, and this has really been the revenue driver for SoFi over the past few years, is financial services. This is all the traditional financial services that traditional banks and brokerages offer. So things like stock trading, cryptocurrencies, margin loans, credit cards, bank accounts. Again, another scalable business that can just simply be a fee-based business for SoFi. But the reason that they're able to attract customers and they're able to grow this business more quickly than traditional banking competitors is because this is a digital-first business, and their app experience and website experience are just going to be much simpler and cleaner than their competitors. That's really where they have differentiation. They also don't have the same legacy costs as a lot of those competitors. If you just look at the banking industry, a lot of banks are trying to get out from under loans that they've given out over the past few decades at much lower interest rates. That means they can't offer the same yield as SoFi can on deposits into savings or checking accounts. SoFi also doesn't have legacy costs that are associated with physical buildings, bank branches, loan officers. All of those kinds of costs just simply don't exist at SoFi. So that gives them a leg up on the competition. And that is why this is one of the top fintech stocks on the market today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The next one is Robinhood. Robinhood came public in the YOLO trading market during the pandemic, but it's a very different company today than it was back then. Yes, it's still making money from things like payment for order flow. That was what allowed it to offer zero cost transactions. But since then, Robinhood has gotten into a lot more products. They now have a gold membership that has introduced a credit card business that is growing extremely rapidly. They're also growing their retirement accounts up about 9x in the past year. So this is a business that's maturing much more quickly than you may think, and it's riding long-term, multi-decade growth trends that are only going to continue. There are a few things to think about with SoFi when it comes to their long-term growth. First of all, They have a much younger cohort of investors than traditional banks and brokerages. So those investors are going to get wealthier over time, and they're going to be inheriting money to the tune of hundreds of billions of dollars over the next 10 to 20 years. That's something that SoFi is going to be able to ride. It's just going to be a tailwind for the business. The other thing is they are only scratching the surface of their international growth. SoFi has name recognition in the US, but they have a very, very small presence in most of the rest of the world. So that should be an area that they should be able to grow relatively quickly. Again, because this is a digital first company. Growing into new markets isn't going to be expanding the number of physical locations that they have or the number of people on the ground. It's just going to be introducing those digital products and attracting customers. The third thing is we are only scratching the surface on the type of accounts and services that Robinhood is offering. There are multiple retirement accounts that they could start to offer, college savings accounts, custodial accounts, joint accounts for families. These are all going to be tailwinds for Robinhood's business. And you can see from this chart that the company's momentum in attracting deposits, in net deposit growth, has been tremendous over the past couple of years. I think this momentum is going to continue. It's going to be volatile. That is absolutely going to be the case because the market is typically volatile over time, but you want to ride the tailwinds that Robinhood is riding. And that's why I think this is another one of the top fintech stocks today. The third one, maybe a little bit surprising, that is Coinbase. Coinbase is going to be much more of a disruptive player in fintech, and often isn't really thought of as a fintech company. It's thought of more as a cryptocurrency company, but I want to take that fintech angle with Coinbase. And the reason is I think the blockchain itself is going to be a disruptive force in technology and in financial services. This shows some of that growth here. This is the non-trading revenue for Coinbase's business. In dark blue, you have stablecoin revenue. Light blue is blockchain rewards revenue, so things like staking. Orange is custodial fees, and purple is other subscriptions and services. A lot of things are included in there, but that's going to be things like wallets as a service. Their stablecoin is the USDC. They built that with Circle, and they're a beneficiary as the market cap expands for the USDC token. So as use cases increase for stablecoins, just think about something like Stripe announcing that they're going to be allowing stablecoin transactions, and that transaction fee is going to be about half of the fee to accept a credit card. This is where there's real disruptive potential for a company like Coinbase, is making it faster and more efficient to move money around the world. I think that's where we're going to see this non-trading revenue continue to grow for Coinbase. They're going to be a really big player in the blockchain. A lot of optionality for growth as well. They have the base blockchain, all of the developer tools that they're building there. They have some cloud services. And of course, on top of that, they do have a large trading business, and that is growing not only in traditional trading, but also in derivatives around the world. So Coinbase is going to ride all of the tailwinds of the cryptocurrency and blockchain market. A lot of those could open up over the next 5 to 10 years as regulations become more clear and more markets are opened up to the blockchain. So there's 3 stocks that I think are no-brainers in fintech today. All stocks that I own, that is SoFi, Robinhood, and Coinbase. Let me know what you think of those in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.